Hi, I'm Camila, and this is the explanation of problem 2a from chapter 10. And we have to journalize and post note transactions. Elliott Corporation sells rock climbing products and also operates an indoor climbing facility for climbing enthusiasts. During the last part of 2017, Elliott had the following transactions related to notes payable. On September 1st, issued a 12,000 note to Piken to purchase inventory. With 3-month note payable, there's interest of 6%, and it is due December 1st. Elliott uses the perpetual inventory system. So on September 1st, we debit inventory because it's a perpetual inventory system instead of purchasing. And we credit notes payable for the face value of the note, which is 12,000. Next, on September 30th, we have to accrue interest for the Piken note. So we debit interest expense and we credit interest payable. The amount is calculated here, the face value of the note times the rate times the fraction of 1 year, which is 1/12 in this case. So we times all these values and that gives us $60. It's the accrued interest payable in 1 month for this note. Next, we have a new note on October 1st, issued a 16,500 8% 4-month note to Prime Bank to finance the purchase of a new climbing wall for advanced climbers. The note is due February 1st. And so now we issued a note to a bank. So we receive cash, we debit cash, and we credit notes payable for the face value of the note, which is 16,500. Next, on October 31st, you have to accrue the interest for the first note and for the second note that we issued. So we have to add those interests. We know that in the case in the first note, we have an accrued interest of $60, and for the second note to Prime Bank, this one, we know that the face value of the note is this and times the rate, which is the 8%, and the fraction of the year, because it is only has passed 1 month, so 1/12 times 1/12. That gives us $110. If we sum this interest, we get $170, which is this amount here. Next, we have another note on November 1st, and issued a 26,000 note and paid 800 cash, 8,000, and paid $8,000 cash to purchase a vehicle to transport clients to nearby climbing sites as part of a new series of climbing up classes. This note bears interest of 6% and matures in 12 months. So on November 1st, I used equipment account. I'm not sure if that is correct, but you can comment in the discussion board if you are certain. And we credit the notes payable and also the cash. Notes payable at times value, but in this case we have to add the cash to equipment. So we have these two and we get 34,000. On November 30th, recorded accrued interest for the Titan note, the Prime Bank note, and the vehicle note. All three notes. So November 30th, interest expense, interest payable. Like every other, as all the others transactions. And in this case, we have to add the last one note, accrued interest note, which is the face value of the note times the rate in 1 month. It's 130. The sum of all these three is 3,000. Which is this one here. On December 1st, we pay principal and interest on the Titan note. So on December 1st, we debit notes payable to take it off the books, and we also debit interest payable to record the payment of the accrued interest, and we credit cash for the sum. And now we used all the accrued interest here, the raw amount of the interest. And the last transactions on December 31st, we have to accrue interest from the Prime Bank and the vehicle note. So December 31st, interest expense and the debiting and interest payable credit. And now we have to add these two amounts right here, and we get 240. And now we ended with the part A in the instructions. Prepare journal entries for the transactions noted above. On part B, post the above entries to the notes payable, interest payable, and interest expense accounts. Use T accounts. And so here, I already made this T account. On notes payable, we have normal credit balance of 42,500, and interest payable of a normal credit balance of 590, which is the hint of is here, and interest expense with a normal debit balance of 770. Part C, it says show the balance sheet presentation of notes payable and interest payable at December 31st, which is right here. And as current liabilities, notes payable for this amount in the balance, the T accounts, and interest payable for this amount, 509. And The part D, it says it's a question. How much interest expense relating to notes payable did Beller incur during the year? Which is the amount right here, interest expense, 770. So the total interest expense the company incurred in the year about 770. And that's it. So if you have a comment or if I missed something or I did something wrong, because I don't really know if I am doing the right thing, I guess. You can please comment and we can benefit of that comments.